When was the last time you stopped mid-scroll, glanced at your balance, and asked yourself which quiet decision today could shape every paycheck you earn from now on, starting right now? I am not talking about chasing a hot tip, copying a stranger's trade, or jumping into whatever is trending this week. I mean one steady move that compounds while you live your life. Picture a tiny snowball at the top of a long hill. It barely fits in your hands, yet every rotation grabs more snow, and soon the new layers start grabbing layers too. That silent chain reaction is compounding. It is not flashy, but it is the force that magnifies small beginnings into serious numbers as long as you give it time and calm hands. Today, we are solving one riddle. How big must your first snowball be before the hill turns gravity into your unpaid helper, and the progress becomes visible enough to keep you going? Stay with me, because the number is simple. The real prize is the map, and it is built for ordinary earners who want a plan that still works on busy weeks and stressful months. Quick favor before we start. Hit like, subscribe, and turn on the bell. These videos are designed to be watched in sequence, and the next one after this milestone matters even more. Most people misunderstand compounding because they picture math class, decimals, formulas, and confusion. Or they assume compounding is for people who already have money, not people building it. The truth is almost the opposite. Compounding is patient, but it is relentless. It rewards consistency more than brilliance, and it rewards time more than motivation, because time never gets tired. Here is the clean definition. Compounding means your gains become part of the base that earns future gains. You do not just earn returns on money, you earn returns on past returns too. Think of it like a flywheel. Early pushes feel pointless, but each push stores momentum. Eventually, the wheel carries itself, and your job changes from pushing hard to not interrupting it. That is why the first years feel slow. The base is small, so the growth looks quiet. But quiet does not mean weak. Quiet means the engine is warming up behind the scenes. People get distracted because loud paths look faster. Rental properties can work, but they demand repairs and paperwork. Crypto can spike, but it can also drop while you sleep. Side hustles can help, but they often trade your evenings for income. And burnout has a nasty habit of showing up right when you need consistency the most. Compounding is the quiet partner. Feed it regularly, and it keeps working while you cook, read, exercise, or relax. Your life stays yours, and the snowball keeps rolling anyway. Compounding does not care if you feel late or if you feel small. It cares about two things: consistency and time. Even modest contributions can become serious when they keep arriving and stay invested. To answer the riddle, we will work backward from a dream that feels solid, not fantasy wealth, just a number that represents options, breathing room, and control over your time. A lot of people use $1 million as that symbol, not because it is magical, but because it is a simple marker that tells your brain you are no longer fragile. If you had $1 million invested, you could handle emergencies without panic. You could negotiate work with confidence. You could say no more often, and that alone changes your life. So let's do one reality check. Imagine you have 20 years, and your money grows at an average of 8% per year in a broad index fund, with no additional contributions. To end at $1 million in 20 years, you would need about $214,548 at the start. Time does work, but the ticket is still steep. Now, turn the dial to 30 years. Same 8%, 10 extra years of patience. The starting amount drops to about $99,377. That is lesson one. Time is a lever. More time can cut the entry hurdle in half without asking you to earn more, work more, or take more risk than you already planned. But returns vary, so we stay grounded. Think of 4 growth lanes, not predictions, just lanes that show how sensitive the finish line is to the rate of return over decades. Lane 1 is 4%, like a conservative long-term mix. Over 30 years, you would need about $308,319 to reach $1 million. Lane 2 is 6%, closer to a balanced approach. Over 30 years, you need about $174,110 at the start. Lane 3 is 8%, the classic long-term stock pace. Over 30 years, you need about $99,377, the number we already saw. Lane 4 is 10%, which broad equity markets have sometimes delivered over long stretches. Over 30 years, the starting amount falls to about $57,309. Notice the pattern. A few percentage points do not just help a little. They reshape the curve, and they reshape your required starting capital more than most people ever realize. Also remember, averages hide chaos. Some years will be negative, some years will be huge. Your plan must assume wobble, because wobble is normal. The goal is to survive the wobble without changing the plan. But here is the twist most people miss. The most powerful factor is not the rate, it is your behavior, because behavior decides whether you stay invested long enough to let math work. If you panic sell after ugly headlines, or you stop investing every time life gets chaotic, the snowball stops rolling and starts melting. The hill cannot help you if you step off it. So rule 1 is plain. Once you start the compounding machine, keep your hands off the gears. Your job is to build a system that protects you from your own emotions. A guardrail helps keep an emergency fund outside the market so you are not forced to sell in a downturn. When your bills are covered, your portfolio can ride volatility without emotions driving decisions. Now you might ask, if 57,000 could reach 1 million at 10%, why not just aim for that and call it done? Here is why. Life is not a spreadsheet. Markets wobble, jobs change, emergencies happen, and feelings run hot. We want a target that still wins, even if future returns are lower, and even if your timeline gets interrupted. We also want a target that is easy to picture, easy to track, and fun to celebrate. Your brain loves clear checkpoints, because clear checkpoints keep you consistent when motivation fades. That brings us to a line many seasoned investors talk about, not as a finish line, but as ignition. Before you reach it, compounding feels like whispers. After you reach it, it talks. Before I name the number, let me show you why small balances feel discouraging, even when the math is working perfectly. The base is simply too small for the growth to feel personal. If you have $5,000 invested and it grows 6%, that is $300 in a year. Useful, but it does not change your decisions or your confidence day to day. At $20,000, 6% is about $1,200. You feel it a little, yet it still looks like background noise compared to rent, groceries, and utilities. At $50,000, 6% is about $3,000. Now the engine is humming, but many people still treat it like it is fragile, so they keep interrupting it. There is a point where the growth becomes loud enough to motivate you through boring months and scary headlines. That point is where progress stops feeling imaginary and starts feeling earned. That point is where you stop feeling like you are pushing a boulder uphill and start feeling like the hill is helping you. It is a psychological shift, but it is backed by real math. Here is the number, $100,000. It is where compounding starts to feel serious for most people, because the annual growth becomes meaningful, even without new contributions. At $100,000 invested, a 6% year produces about $6,000. That is real money, and it arrives without extra hours, extra stress, or extra negotiating at work. And the key is what happens next. In year 2, you are not earning 6% on $100,000 anymore. You are earning on $106,000 because gains join the base. By year 10, at 6%, the annual gain is about $10,137. Now the growth can fund vacations, repairs, or extra investing with less strain. By year 20, at 6%, the annual gain is roughly $18,154. At that point, the portfolio can outsave what many households manage to save. That is why $100,000 is ignition. Not because it is the finish line, but because it proves the system is alive, and it gives you momentum you can measure without squinting. I have seen people quit at $80,000 because it still feels slow. Then, a few years later, they realized the last $20,000 would have been the easiest, because momentum was already building. Now the obvious question, can an ordinary earner reach $100,000 without a lucky break? Yes. And the timeline is shorter than most people guess. If you stop making 3 mistakes, in a moment I will show 3 monthly contribution levels and what they produce. Then I will show the 3 leva map that speeds everything up without gambling and without needing perfection. First, we kill a myth that keeps people stuck. You do not need to be a stock-picking genius to earn long-term market-like returns. Most people win by being boring and consistent. A low-cost index fund that tracks a wide slice of the market has historically done the heavy lifting over long periods. Your advantage is not secret information. Your advantage is endurance. Another myth says you must watch your account daily. In reality, looking too often can damage results because every dip feels like an emergency, even when it is normal volatility. A monthly or quarterly check keeps you informed without feeding fear. The goal is to stay invested long enough for compounding to show up, not to feel smart every single week. Now the timeline, using a steady 6% growth assumption with monthly investing, if you invest $850 per month, you reach $100,000 in about 7.7 years. If $500 per month is more realistic, you reach $100,000 in about 11.6 years. That is a single decade, not a lifetime, and the years will pass anyway. If you can only do $250 per month, you still reach $100,000 in about 18.4 years. The difference is not possibility. The difference is timeline. Here is the retention secret. You do not need a perfect year to hit the goal. You need a system that survives imperfect months because imperfect months are the rule, not the exception. Now for the map. 3 moves: quiet, repeatable, and powerful. If you apply them together, 100,000 becomes a schedule, not a wish, because the inputs are under your control. Move 1 is automation. Your savings should leave your checking account the moment your paycheck lands. Money you never see is money you do not negotiate away on random cravings. Automation removes willpower from the equation. It turns investing into a default. Set contributions on a schedule and set dividends to reinvest, so the snowball keeps packing layers. Move 2 is increasing income without turning your life into a hustle prison. You do not need 20 extra hours a week. You need higher value per hour, even in small bursts. That can be tutoring, freelance editing, weekend repair work, or a short skill upgrade that increases your earning power. The goal is simple: create a stream of extra dollars. Then apply one rule that changes everything. Every extra dollar goes straight to your investment account. Do not let lifestyle inflate and steal the fuel that was meant to grow the snowball. One of the fastest accelerators is your next raise. If you invest half of each raise before you adjust your spending, you upgrade your future without feeling deprived. Raises are powerful because they repeat every year. Move 3 is cutting quiet leaks that do not deliver real joy. Unused subscriptions, forgotten fees, convenient spending you barely remember the next day, and interest charges you can avoid. You are not cutting fun, you are cutting waste. Each leak you seal becomes a permanent monthly raise for your portfolio, and permanent raises compound faster than one-time wins. Stack these 3 moves, and the timeline shrinks. The math does not care where the dollars come from. It cares that they arrive consistently and stay in the machine long enough. Now we need to talk about the biggest threat to your timeline. It is not the market. It is quitting halfway, right before compounding becomes visible enough to motivate you automatically. The early phase feels slow because the base is small. That is normal. Do not mistake normal for failure. Slow progress in year 1 is often the setup for fast progress in year 10. This is why 100,000 matters. It is the point where the progress becomes loud enough to keep you consistent because the account starts generating noticeable gains on its own. If you are at the beginning, here is the move for this week. Pick a contribution you can sustain for 12 months, set it to automatic, and stop treating investing like a mood. Then choose one lever for the next 30 days. Earn a little more or spend a little less, and send the difference straight to the portfolio. Small wins become big because they repeat. Here is a mental trick that makes discipline easier. Treat every invested dollar like a worker you hire. If you spend it, the worker never shows up. If you invest it, the worker reports daily. Reinvesting is just refusing to leave workers idle. That is why dividend reinvestment matters and why staying invested matters. You are building a workforce that builds a bigger workforce. Now the fear that stops most people. What if the market drops right after I invest? It will, at some point. That is not a bug. That is the price of long-term returns. The goal is not to avoid volatility. The goal is to be positioned, so volatility does not scare you out of the plan. Lower prices can be good when you are still accumulating shares. The winners are not the people who predict drops. The winners are the people who keep buying through the noise, because they have a system, not a guess, and their system keeps showing up. If a major crash hits, remember this: recoveries tend to reward the people who stayed invested. The exact timing is unknowable, but the direction over long spans has historically been upward for diversified markets. Mid-video checkpoint. Comment your current stage. Under 10,000, 10 to 50, 50 to 100, or above 100, and say which lever you will pull next week: automate, earn, or cut leaks. I read the comments, and your answer helps other viewers see they are not alone. Momentum is contagious, and sometimes one honest comment does more than 100 motivational speeches. Now zoom out again. Once you hit 100,000, the game changes. But not because you become smarter. It changes because the math becomes loud enough to be felt in daily life. A normal year can produce thousands without you lifting a finger. That is measurable proof that the system works, and it is why many people say the first 100,000 is the hardest. Not because the formula changes, because you are doing most of the pushing before the hill starts helping. You must believe in the process before the process rewards you visibly. So the goal is not perfection. The goal is momentum. If you miss a month, restart the next month. The snowball does not care about guilt. It cares about contact with the hill over time. Keep the portfolio side boring. Low cost, broad exposure. Long horizon. The fancy part is not selection. The fancy part is building behavior you follow when you are busy, tired, or bored. Now let's close the loop from the opening riddle. The number was 100,000. The map was automation, income, and leak cutting. The secret ingredient is leaving it alone long enough. Compounding does not reward intentions. It rewards time in the market and consistency of contributions. The sooner you start, the less you need to shovel in later, because time does more lifting. If 100,000 still feels distant, zoom in, focus on the next month, not the next decade. Systems are built one scheduled deposit at a time, and the snowball grows one layer at a time. Here is the next promise. In the next video, I will show what changes after 100,000, and the next checkpoint that makes your progress feel even faster than you think it should. Final question. What is one change you will make in the next 48 hours to put your plan on rails? Write it in the comments, then do it. See you next time.